Everybody, Alex here. In today's video, we're going to cover a couple different things. Number one is, primarily is what's the best type of policy designed to use for infinite banking. So within that, there's a couple different things that we'll need to cover. Number one is the different types of insurance products there are, why you can and cannot use them for infinite banking. Number two, we're going to look at some different types of policy designs. So we'll look at a traditional policy, aka the kind that your Dave Ramsey's, your white coat investor, your Susie Orman's, the kind that they hate and abhor whole life for, because they say you don't have any cash value until like years 7, 8, 9, 10, which can be true in a sense, but it's also a very huge misconception. So we'll cover all that. But then we'll also cover what the most efficient policy design you can use for the infinite banking concept, because there's a bunch of different ways that you could do it. So the short answer, spoiler alert, is it depends on what you're looking for. But let's talk about why somebody would do infinite banking in the first place. People would do infinite banking because they don't want to ride the stock market ups and downs. They want more control over their money. They want a guaranteed amount of growth, and they want it to grow uninterrupted. Let's say you have a high yield savings account or a savings account of any kinds. You have $200,000. You want to use 20 of it. What happens if you do basic math? Your 200 is now 180, and there's no way for you to replenish that without your income. So a lot of folks that aren't well capitalized, they're reliant on their income in order to have access to different investment opportunities and in order to increase their cash flow, which is like 99% of people. So if that's you, it's not your fault. That's a lot, a lot of people. People also want more control over their capital. So with a whole life policy, you're in control of how much it grows by. The insurance company also has some skin in the game because they are contractually guaranteed to have your cash be a certain value at a certain period of time, at minimum. That's before dividends. And again, I'll get into dividends here in a minute. But people also want an additional pool of capital to finance their life or increase their cash flow by getting into cash flowing investment opportunities without needing to work more. Like, it's really just that simple. Like, infinite banking is not about rates of return. Nelson Nash says that in the 6th paragraph of his entire book, Becoming Your Own Banker. It's not about rates of return. Now, before you come at me in the comments with,
well, rate of return does matter.
Yes, it does, because your money has to grow, obviously. But if you're just chasing returns, then infinite banking, probably not the thing for you, which is fine. It's not for everybody. That's okay. Let's talk about insurance products. So there's really two types. There's term, which is, you're probably most familiar with this. It's a specified amount of coverage for a specified amount of time. If you go outside of that period of time, then you don't have coverage anymore. So why would somebody do this? Well, if you think that you can essentially, you know what the market's going to do, which nobody does, but if you know what the market's going to do and you can reasonably assume that the amount that you're investing will appreciate to a level to where you don't need the life insurance dollars or capital, that's why somebody would do this. So you probably hear a lot of people say, buy a term, invest the difference, whole life sucks. That's what they're talking about. You take your premium with a term policy, you subtract it what you would pay in premium from a whole life policy that's equivalent death benefit, and then you just invest that difference in the stock market. Well, the problem with that is what most people do is they do that with like a 401k or an IRA. Well, the problem with that is that the stock market is, let's call it what it is. It's essentially just legal gambling. Like, yes, you have infinite upside potential, but you also have infinite downside potential. So there's no protection from, say like a 10, 15, 20, 30% market swing negatively, like right before you retire. That's just devastating for a lot of people. So there's no protection from that. Like, a lot of people are just kind of doing stock picks. Maybe they're doing S&P 500, getting the dividends from that, which is it's nothing wrong with that strategy. But just keep in mind, like, most of the folks watching this are probably not professional investors. You might be missing out on some returns that you could otherwise be getting, but that's neither here nor there. The other type of insurance products there are permanent products. So like your whole life, universal life, index universal life, variable and universal life. Those are the permanent types of products. So it's exactly what it sounds like. You would have a specified amount of coverage for the rest of your life. Now, why would somebody do a permanent policy of any kind? Well, they don't want to run the risk of being uninsurable around the time when term expires, which is like 50, 55, 65, 70 plus. And no insurance company is going to touch, with a reasonable amount of premium, no insurance company is going to touch somebody that old, because insurance companies are in the risk mitigation business. And whenever somebody passes away, like, they have to pay out that money, which eats into their profits. So that's not good business to just willy-nilly cover, old folks. Sorry. It's just not. Speaking from the insurance company's perspective here. So somebody would get a whole life policy to ensure that they will have some kind of coverage available. Some people just want the peace of mind. Like, who am I or who are you to say what people should do with their peace of mind? But anyway, neither here nor there. Now, with infinite banking, we need to check a few boxes here. We cannot do traditional Nelson Nash infinite banking with a universal life policy of any kind, just because with whole life specifically, there are certain guarantees in place, like contractual guarantees in place that your money is going to grow at a certain rate and a certain amount by a certain date. You don't have that with universal life of any kind. You can do a version of infinite banking with those, but it's not quite the same. Now, within whole life specifically, we need to check a few boxes. These are the best types of policies to do the infinite banking concept with, but we need to keep an eye out for a few things. Not all whole life policies with regards to infinite banking are created equal. So number one, we need to have a whole life policy from a dividend-paying, mutually owned insurance company. What the heck does that mean? So in a mutual company, the policy owners are also the owners of the company. Now, you have a stock company. A lot of stock companies offer whole life policies, but those dividends, if they pay dividends, those dividends are going to stockholders, which may or may not be policyholders. They don't have to be. But if you want to own a piece of a mutual company, you have to have a policy. That's what you want to look for. So a lot of people think they're getting into infinite banking and they get a policy set up with a stock company, and it's not what anybody was thinking. And they just got fleeced by an insurance agent that just wanted a high commission. Let's get into some policies, finally. So here we're looking at a traditional type of whole life policy. So you can see an expensive death benefit with an expensive premium and not a ton of cash value, at least not initially. Now, why the heck would somebody get this kind of policy? Well, this type of policy is really great for estate planning purposes. If you're looking to funnel a certain amount of cash to your trust or to your beneficiaries or to your heirs, tax-free. Whole life insurance in general is a great place to legally avoid taxes. Let's take a look at this. $12,000 a month in this particular policy. You can see no cash value year one, no cash value year two. Oh, we have some cash value here. $7,400 year three. But the problem is that we've paid $36,000 into this policy. So if you're looking to do infinite banking with this type of policy, it's not the most efficient way to do it. But if you're getting this type of policy specifically for the death benefit, and then maybe you'll do infinite banking, maybe you won't. Like, if that's something that you want, go for it. Just know that this is a good type of policy to have for a certain type of situation. Now, if you have a type of whole life policy like this and you want to do infinite banking properly, you're probably asking yourself, should I cancel my policy? I never recommend anybody cancel a policy unless they really want to, because you can do infinite banking with this. It's just not the most efficient way to do it. Okay, so this is the type of policy that whole life gets a bad rap for. And when we cover the other types of policy designs, I'll show you what to look for, so that way you don't get scammed by some agent who tells you you're getting into infinite banking, but they're really selling you something like this for a higher commission. And it's fair enough, with your Susie Ormans and your Dave Ramseys, and this is because they detract from this, which is fine. I get where they're coming from. And there's also a lot of agents out there that will sell you this in a heartbeat, telling you you're getting into one thing and then it winds up being something else. Because there's just not a lot of education out there in the industry on how to properly do this. And full disclosure, like, this is the highest commission whole life policy I could possibly sell to you. The more liquid I set your policy up to be, the less my commission is, which I'm fine with. But just so you know, the insurance companies don't incentivize properly structured policies for infinite banking, just so you know. Now, if this was properly set up, the insurance agent's commission could be cut anywhere from 60 to 90%. And that only benefits you. So just so you know how this, peeling back the curtain here. Now let's take a look at a 40-60 policy. You're probably wondering what the heck is 40-60? Well, let's go back to this traditional here for a second. You'll also notice there's no dividends here in the annual dividend column. So I'm going to get into dividends with the next policy design. So 40-60, what the heck does that mean? Well, with every premium we pay every single year, every single month, a portion of our premium needs to go towards the base. This isn't a life insurance product that we're talking about, so we do need to have some death benefit. We cannot have cash value without the death benefit existing. Anybody that tells you otherwise is misinformed at best, or at worst. They're misinformed at worst. The other 60% is going to go to paid up additions. What the hell is a paid up addition? A paid up addition is a small block of fully paid up insurance that will increase your death benefit, which thereby also increases your cash value, which thereby also increases your policy's growth. So as you can see right here, well, let's go back to this traditional for a second. So we have this flat death benefit right here of over $1 million, and it never goes anywhere because we're not putting any portion of our premium towards those paid up additions. If we come back to this 40/60, you'll notice the death benefit is also way less because less of the premium is going towards the base. So you don't need as much death benefit earlier on. But as you can see, it grows throughout the lifetime of the policy, and so does your cash value. Now let's talk about dividends here. What is a dividend? A dividend, the reason that you want a mutually owned insurance company is because the dividends go to the policyholders who are also the owners of the company if you're keeping score. What is a dividend? A dividend is, Dave Ramsey for some reason gets upset at this, but a dividend is basically a return of premium. So an insurance company every year calculates their estimated expenses and subtracts that from their estimated revenues, aka the premiums that are coming in. So expenses could be mortality claims. They obviously have employees, so they need to pay those. All of those go into expenses. So the difference of those two is what the dividend is. And keep in mind, dividend rates go up, dividend rates go down. So don't get married to a particular company's dividend rate because what it is now is not what it's going to be a month from now or a year from now or whatever the timeline is. But what is really cool about dividends is that you can use those dividends to purchase more paid up additions to increase your death benefit, increase your cash value without having to pay more out of pocket. So you can see right here, this death benefit, while it does start out small, you have access at minimum to $6,700 of cash value year one, right away. You add in the dividend, you have access to this much. Now we also need to look at when these policies break even. One piece of ammunition that the whole life detractors have, infinite banking detractors have, is they say these policies don't break even until years 7, 8, 9, 10. You might as well just invest in something that's going to break even a lot sooner, which is true, but we need to change our frame of reference for a few things when it comes to these policies. Number one, we need to look at each of these policies as their own business. Now, if you look at any large corporation, when they open a new subsidiary or any new corporation, they're not going to expect to be profitable for 6, 7, 8, 9 years, at least. Like, it's just part of the game. They get how that works. So that's why you need to look at these as a business and not expect it to break even right away. We also need to not look at paying premiums as some kind of burden or look at it in a bad light. The premium is where we're going to see if we can pay the most amount of premium for the longest period of time, that's where most of your capitalization or all of your capitalization really is going to come from. So if you're an entrepreneur and you're watching this, you know that the more you invest in your business, the more it's going to output, the more it's going to return for you. It's the same exact thing with this. So for this particular example, this guy is paying $12,000 a year for 20 years. Break even is going to be between years 8 and 9. What is break even? Well, it's when your cumulative premiums, aka a total amount of premiums that you paid, is equal to or less than the net cash value. So you're going to break even sometime with this particular policy between years 8 and 9. Now, in theory, you could turn your premiums off and stop paying. But again, you need to look at this as a business. So I do not recommend that to everybody. I only recommend that in certain situations. Because if you were to turn premiums off, you're just shooting yourself in the foot for growth later on. So the more premium we can put in for a longer period of time, the more growth you're going to see later on down the road. Now, let's take a look at a 1090. So a 1090, if you're keeping score, that means 10% of your premium is going towards the base. 90% of your premiums are going towards paid up additions. So let's take a look at what this actually looks like. $12,000 a year. You immediately, year one, have access to $10,000 liquid that you can use for whatever you wanted. So if you're keeping score, I've been saying that a lot, 6,700 over here, 10,000 over here. And keep in mind, the more liquid it is earlier on, the less the agent's commission is. But the more you benefit if this is something that you're looking for. You can also see less death benefit, but the dividends are going to be about the same. Now, Why would somebody get a higher liquid policy earlier on versus something that's more long-term oriented? So mainly the types of folks that would want a higher liquid policy or more liquid policy earlier on are like real estate investors. So they would typically park money into something like this because it's protected from creditors. It grows tax-free. You don't have to pay gains on the taxes. You don't have to pay income tax to leverage this money that's in here. But they also need access to a lot of their money so they can go on a real estate opportunity if one comes up. I want you to notice, so this policy, before we get into that, this policy breaks even a little bit sooner. So between years 6 and 7. So you can see right here, 72, 74, and then here we have 84 and your cash value is 88. But I want you to pay attention. If we come down to year 60, and we can talk about why this drops off here in a bit. I don't want to get too technical with it. There's a term rider with this. Basically, a term rider prevents this from being a modified endowment contract. I'll do a separate video on that later. But just know that this policy, the premiums that you have to pay starting at year 60, drops off from $12,000 to $1,200. Now, I want you to keep that in mind because when you have, and I'll show you what I mean, the more liquid your policy is earlier on, you're sacrificing long-term growth for higher liquidity. If we look down here with the dividends, you have $603,000 liquid, you've put in $257,000. That's a pretty solid. But if we come over to this 40/60 right here, same year, make this a little bigger, same year, same amount of time, but notice you can put more premiums in for a longer period of time with this 40/60 policy than you can the 90/10 or 10/90. So that's a difference of about $60,000 in cash value. May make a difference to some, it may not, but just so you know what's going on. And we have more, I think we have more. Yeah, we have more death benefit. So the longer this person lives, the more growth they're going to have later on, as opposed to the 10/90. So the 10/90 is going to limit how much premium you can put in without it turning into a modified endowment contract later on. Back to the question of what's the best type of policy design? Short answer is it depends on what you're looking for. Why are you getting a policy like this in the first place? What are you hoping to achieve? What are your goals with this? Like, it requires you to think about and be able to answer those questions, because what's good for somebody that wants a 10/90 is not going to be good for somebody that wants a 40/60. It all just depends. Unfortunately, it's probably not the answer you wanted to hear, but as a financial professional, I can't give you a solid answer without knowing more information about your situation. But what's good for some might not be good for others, and I can't know that without knowing more about your situation and what you're hoping to achieve with something like this. Now, you may also want to look at front loading a policy, which I can do. That's a separate video. I can do one on that. As a matter of fact, that's the next one I'm going to do. So if you hit that subscribe button, you'll know when I do it. Now, you can front load it, pay more premiums later on. There's all kinds of different ways. There's more than one way to skin this cat. If you found this helpful, share it with somebody that you know. If you're interested in having a completely no pressure conversation on what this could look like for you, I'm going to drop a link in the video description where you can book an appointment with me, 15 minutes on phone or Zoom, whatever works. And we can just talk about it. If it works, great. If not, that's okay too. And by the way, the other type of insurance product that there is a convertible term. So with a lot of people, you can get term now, maybe because you're not financially ready to commit to something like this, or maybe you have health issues that you're looking to shore up. A convertible term is a good placeholder if you're looking to do infinite banking, but you can't quite yet. I recommend those to folks all the time. So if you're interested in having a conversation about that, book an appointment with me. I'd be happy to sit with you, see where you're at with everything, see if we can help. But otherwise, share this with somebody that you know we would find helpful, and stay tuned for more videos. See ya.